All right, welcome. Today we're diving into something really fascinating, harmonic patterns. This is a powerful way some of the most advanced traders find a hidden geometry inside what looks like total market chaos. So let's jump right in. So let me start by asking you a question. When you look at a price chart, what do you see? Is it all just random noise, totally unpredictable, or is there maybe a hidden order, a secret structure that you can actually learn to see and trade on? Well, for harmonic traders, the answer is a huge yes to that hidden order, and they find it using these things called harmonic patterns. Now, these aren't just random shapes. They are very specific geometric formations that use precise Fibonacci ratios to pinpoint potential turning points in the market. We're talking about a high probability way to find reversals. And you know, this isn't some newfangled idea. The concept actually goes way back to 1935 with Gartley. His work was then picked up, refined, and really formalized by Scott Carney. And today, these patterns are a must-have tool for any serious technical trader who's looking for a real mathematical edge. So how do they actually work? What's under the hood? Well, let's get into the blueprint, the actual DNA of what makes a harmonic pattern. It really all boils down to two fundamental pillars. First, you've got the engine, the Fibonacci ratios. That's the math behind it all. And second, you have the framework they all share, a very distinct 5-point structure. Every single pattern, no matter what it's called, is built on these two things. And at the absolute core of it all is this number, 0.618, the golden ratio. This number, along with a few others derived from it, like 0.786 and 0.886, they form the entire mathematical backbone. They are the rules that define the exact proportions between the swings in a pattern. And here's the skeleton that holds that math together. Every single harmonic pattern is defined by 5 key turning points. We just label them X, A, B, C, and D. This 5-point structure is what we use to identify and measure every pattern we find. Let's just walk through building one, step by step. It all kicks off with a big initial move. We call that the XA leg. Then the price pulls back, creating the AB leg. From there, it pushes up again in the BC leg, which then leads us into the final and most critical leg, the CD leg. And that move finishes right at point D. That D point, well, that's everything. Because you see, point D isn't just a single price on a chart. It's what defines something called the potential reversal zone, or PRZ. Think of it like a hotspot. It's this concentrated little area where a bunch of different independent Fibonacci calculations all point to the exact same place. And when that happens, the probability of a reversal goes way, way up. Okay, so now we have the blueprint. Let's take a little tour through the gallery and look at a couple of the most important patterns out there. Each one has its own unique signature, its own feel, and its own super strict set of rules. We have to start with the classic, the OG, the one that started this whole thing, the Gartley pattern. Visually, you're on the lookout for these pretty distinct M or W shapes on your chart. This is really the foundation of all harmonic trading. But just looking like an M is not enough, not even close. The ratios have to be exact. For a real Gartley, the B point has to be a 0.618 retracement of that first XA leg, and the D point, that potential reversal zone, has to complete at a precise 0.786 retracement of that same XA leg. If those numbers don't line up perfectly, it's not a Gartley, it's just a random shape. Okay, next up in our gallery is the bat pattern. Now, this one can look a lot like a Gartley at first glance, but is defined by a much deeper reversal point. That makes it a really unique and very precise formation. So what's the difference? Let's get specific. The B point is shallower here. It only comes up to about a 0.55 retracement of XA. But the real defining feature, the thing that makes a bat, is its D point. It completes at a very, very deep 0.886 retracement of XA. That deep reversal zone is its signature move. And this little cheat sheet just breaks it down perfectly. The Gartley has got that key B point at 0.618 and the D point at 0.786. The bat, on the other hand, has a shallower B point at 0.50, but a much deeper D point at 886. It's these tiny differences in the geometry that completely change the pattern and the trade itself. Okay, so we can spot them, we know the rules, but how in the world do you actually trade them? Let's shift gears from theory to a practical, step-by-step playbook. It's really a simple 4-step process. First, you spot a potential structure that looks like it could be a pattern. Second, and this is the most important part, you label the points and you measure those ratios with your Fibonacci tools to make sure it's valid. Third, you wait and watch for confirmation right inside that PRZ. And only then, after all that, do you execute the trade.
And here are your rules of engagement. Your entry is going to be at or very, very close to that D point completion. Your stop loss, your safety net, goes just beyond point X, the start of the whole pattern. And for your take profit targets, you're usually aiming for Fibonacci levels of the entire move from A to D. Simple as that.
Now this might be the most important thing I say in this entire explainer. The number one rule of harmonic trading is discipline. You can never ever force a pattern. If the ratios are even a little bit off, if they don't align perfectly, the setup is invalid. You have to be willing to walk away.
So let's step back for a second and take a really honest look at this whole methodology. What are the real-world pros and cons? What are the pitfalls you really need to be aware of?
On the pro side, the precision is just incredible. The patterns give you these crystal clear, objective, math-based levels for your entry and your risk. But the big con? Man, they can be really hard and time-consuming to find by hand. And if you're not careful, it's easy to start seeing patterns that aren't actually there.
So what's the practical takeaway here? The best approach is usually a hybrid one. Use automated pattern scanners. Let the computers do the heavy lifting to find potential setups for you. But, and this is totally non-negotiable, you always have to do your own manual validation to confirm the ratios are perfect before you ever risk a single penny.
So at the end of the day, why go through all this trouble? This chart really puts it all into perspective. You can trade based on pure guesswork, which is a pretty low probability game. You can use classic patterns, and that'll improve your odds. Or, when you correctly identify and validate a harmonic pattern, you are now operating in a structured, mathematical framework that is specifically designed to give you a high probability edge.
So, we've pulled back the curtain on the market's hidden geometry. We've given you the blueprint and the tools to start seeing what, for many people, is completely invisible. The only question left is this. Now that you can see this hidden structure, what is it going to tell you?